Hello, everybody, and welcome to Cycles versus Chaos. So this is a special edition, special report, and today with me, I have two very special guests, legends in the business, Peter Eliades and Jake Bernstein. So Peter and Jake, thank you very much for being with us today.
Thank you, Richard.
My pleasure, thanks.
And I particularly appreciate the title of this little special event today of Cycles versus Chaos, because the word chaos is getting a lot of media coverage today, as though this chaos were somehow something that could not have been anticipated. So I think we're going to cover today how some of this could have been anticipated, and since it could have been anticipated, it kind of suggests that there is structure behind the chaos that most people miss. And that's what this Foundation for the Study of Cycles is here to uncover between all of us, and particularly with yourselves, which I think between the two of you, I hope you don't mind me saying this, there's probably 100 years of market experience between the two of you. So really looking forward to what you have to share with us, and to how, what you saw ahead of time and what you see coming next.
I'm glad you didn't say 200, Richard.
What's that?
I'm glad you didn't say 200.
I'm glad I didn't say 200. So before we get started, just very briefly, I just want to share, of course, our conference, our announcement here. But in June of this year, the 12th to 14th, in New York City at the SUNY Global Center right in Midtown Manhattan. It's a beautiful place, going to be a fantastic conference. Our first in-person conference in decades. Jake, you may have been at the last Foundation conference in person, and it was when, in the late 80s or 90s?
That's right. It was in the Greenbrier and near
West Virginia?
Yeah, West Virginia, right.
Yeah, that's about 2 hours from me. Of course, we have legendary cycles experts, including both Peter and Jake. It's going to be an incredible event. And at the end of our session today, we have a very special announcement about the conference. So definitely stay tuned for that. All right. So with that, Peter, if you would be so kind as to kick us off and get us started, then Jake, and then myself.
Be happy to do that. Thank you, Richard. I'll go to share my screen immediately so everyone can see it. Let me make sure. Does everyone see my screen?
It's coming through. Got it. I see the monthly chart of U.S. security prices. Wow, 1789. So you're definitely giving us a little history lesson here.
Yeah, guess where I got this data, Richard?
Maybe from the Foundation for the Study of Cycles.
Bingo. So
Awesome.
I did this chart myself because I was when I really got into cycle analysis, and before computers, so that's how old I am. I actually had a handmade chart of the Dow Industrials that went across my living room floor about 16 to 20 feet wide.
Oh my goodness.
And this is so much easier. Look at this. This is basically what I had, but I had done it all by hand. Anyway, let me get right to it here. There's a couple of things that have made me quite bearish longer term within this chart. Now, mind you, we'd like to see cycles be repeating for several iterations before we have some kind of confidence that they may provide us with some kind of knowledge as to where we are in the longer term picture. The long-term cycles I'm going to point out here, and I wish I had them better delineated, but I had problems with this before we came online. But there are two or three important points. One of them is right here. This is 1835.
Okay.
This is 1842. This is 1929. And this is 1932. Now, the chart isn't completely up to date. I think it's missing a couple of months up here. But here are the things that made me long-term very bearish. One of them was simply looking at the two most important tops on the chart. And they should be very visible because I would say that the two most important ones because of the decline that happened after them. And I think if you look very quickly, it would be 1835 and 1929.
Mm-hmm.
So if we take the time distance between there and add it on to the 1929, you come up with 2023.
So that's 94 years.
Correct.
So
So you take your 94,
1929 plus 94 is 2023.
takes you to 2023. So that was one of the things that made me start to get very longer term bearish
Mm-hmm.
a few years ago. Okay.
Mm-hmm.
The other one was the old George Lindsay theory about bottom to top. Well, we have 1842 to 1932, probably the two most visible bottoms on the chart because of the decline that led into them. Okay.
Mm-hmm.
1842, 1932, 90 years, go forward from 1932, 90 years, come up with 2022. So 2022 and 2023 to me were time periods where I said, okay, from this point on, any short to intermediate term top that I discern as being one of those should be treated as a potential very long-term top in the market, one that could last for a decade or two or longer. I mean, 1929, as most of you know,
Mm-hmm.
if you're acquainted with the data, this top held for a quarter century from 29, 39, 49 into 54 before it was
Wow.
penetrated.
Wow.
Okay. So I think that whatever top is going to form here could end up being a top something like that. Okay, I don't want to take too much time here because we're only going to do 10 or 15. So I wanted to show you this chart, though, to show you that what I was looking for was every short to intermediate term top could be treated as a potential very important top. With that in mind,
Mm-hmm.
let me show you this. This is a publicity thing that I just did because, listen, I would be lying to you if I said to you, I was very, very bullish all the way up into this high. That's not true. In
Yeah.
fact, I identified most of these tops along the way, and I treated them as potentially very important market tops. Okay. But when we got to this top on February 19th of this year, these are the quotes that I made at them, despite the fact that I had been at least potentially bearish at a lot of these other tops until we went to new highs again. I actually, these are actual quotes from my daily videos. We could be at one of the most important market turning points you will see in your lifetime. And we reminded subscribers on the video we just made one of the very rare recommendations that we make over the past 5 to 6 years of daily videos. And we had them take a negative position on the S&P cash at 61.1750.
Wow.
The very next market day, that was April 14th. The very next market day, February 18th, I said, again, I emphasize how potentially very important this price zone and this time zone are, okay? I wish I could say I stake my reputation on the fact that we are at a market top of great significance. You can't do that in this business. If you do, you're pretty foolish. But I feel pretty damn confident that that's true. That
Nice.
was on February 18th. The all-time high close occurred on February 19th, where the arrow is. And this is updated, I think, through, I don't know, probably a low on April 7th. We've obviously had a pretty big rally since then. But, oh, by the way, I also did a special update on March 25th and said I'm doing this special update because things have come together here to mark the potential end of the rally from the lows that were registered back on March 13th right here. So we call this important top here and this top right here. Now, I'm not going to go through the details of how I did that, not here anyway, but I am going to go through the details in great detail at our June conference in New York City.
Really looking forward to that.
So if anyone wants to see why I said what I said here, and there wasn't just one reason, there were several cyclic reasons and Fibonacci reasons why I pinpointed this as a very important top. Okay, let me take a couple of more minutes here and show you a chart in real time. Okay, here is the S&P daily chart. These are the daily markers, and it's kind of messy, but this is my software that was written for me by Stefan Schuerman that finally got me some software that I could do the Hearst cycle things that I've implemented and made some changes with, and hopefully improvements and whatever over the years. I've been trying to get this application done for 30 years now. And finally, about 5 years ago, we got it done. So the projections are given by the boxes. The green boxes are upside projections. The red ones are downsides. So as you can see now, this is the projection that's currently outstanding. And it's a closing price projection on the S&P. It says log here, and it should not be a log projection. So let me quickly change that. I have the log projections, the capability to do them for things like Bitcoin. This is going to bring this down a little bit from 58.75 to 56.53. So you can see we're 30 points away from the lower end of this box, okay?
So Peter, there's a lot of lines on that chart. I see one line that looks more continuous than the others. Is that the price line of the S&P 500?
I'm glad you said that, because I can show you what I call a web chart, which shows this with a lot greater clarity.
Okay.
Hold on a second. We'll do that right now.
Great.
Okay. Better, right?
Yes. Yes.
So what this gray area is what I call the continuum. I use offsets, as most of you know that are acquainted with the Hearst technique of doing price projections. I use offsets of varying time spans. The one that we're looking at now is a 12-1 to 13-8. It's the equivalent of a 2.5-week offset on a weekly chart. And it has given this projection. Okay. And the way the projection is determined is the front part of this gray area is 12-1. The back part of it is the 13-8 offset. So if you can imagine just moving forward from 12-1 to 13-8 on the offset, that's what I call the continuum. And any part in here where there's a crossing of the offset line with the prices is what determines this upside projection.
Okay. And this is the Hearst kind of related to the idea of the forward line of demarcation?
Absolutely. This is indeed what they call forward line of demarcation. I simply call it my offsets, cycle offsets. Okay.
And it's just price move forward by 12 to 13 days, roughly.
12-1 to 13-8. Now,
okay.
The reason I did that, when Hearst did this originally, they used calendar days. Okay. So it was round numbers, 5, 10, 17.5 to 20, 35 to 40. That would be the 5-week offset. I said, no, wait a minute, let's get practical. I want to do this on market day charts. And so I translated the Hearst nominal 20-day and 35 to 40 and whatever. I translated those into market days. And that's why you have the funny fractions. And that's why it took me about 20 years to get someone to program it. But it's now been programmed and getting the exact offsets and you can see them here. Now, let me say one more thing. With this huge update that occurred here, I was afraid could distort some of the projections because this was such a completely emotional day that was out of sorts completely with typical market behavior. A double-digit gain in the Nasdaq Composite. I think it was 13% in one day.
That was
And
the
indeed,
90-day pause day.
yeah, yeah. And when I started getting shorter term projections, let me show you one here so you'll see what I mean. Come on, folks. Okay. I know this is messy, but this is 3.5 to 4. I'll show it to you in the web chart again. It's a lot more clear. Do this to get closing prices. And I just zoom in here. Okay, there we go. Here's that crazy day right here.
Mm-hmm.
Okay, now that crossed the continuum. Okay, but
Mm.
on this day, when we had crossed the continuum, I said, hold on a sec. We are getting this significantly higher projection, but I don't trust it. And the reason I don't trust it was I don't think this was normal, typical, natural market behavior.
Yeah.
And indeed, that turned out to be right. If you see something, a gray box, that's something that's been invalidated. How does it get invalidated? Price simply moves below the continuum again.
Mm-hmm.
And that's what it did here and invalidated that upside. The same thing is true with a 7 to 8 offset. It gave a much higher projection. It was invalidated. So now that we have the 12-1 to 13-8 that I just showed you, that we're indeed very close to hitting. My argument is we might not even reach that. We're in such an important area right here and now that I'm not sure we'll even get into that projection window. But if we do, then all upside projections will have been met. And what we have to watch then is the equivalent of a 5-week offset, the 24.2. You can see the outlines of it here, the 24.2 to 27.6. If we stay in this zone, let me try and get the web chart again. Okay, here we go. If we stay below the continuum here
Mm-hmm.
over the next week or so, then there will be no further upside projections. You can get further upsides by getting above the upper end of the continuum. And you can see on the chart here, this is 5,700 right here. So over the next week or so, you'd actually have to get above the high 5,700s to give a higher projection. So the important thing is you're in this area where the 12-1, which is the equivalent of a 2.5-week offset, is very close. I'm just going to show you one more thing and then I'll be through. Well, I guess I'll show it on this chart. I was going to show you a different one, but that will take too long to bring it up. I love speed resistance lines. Edson Gould, who I think was one of the top 1 or 2 market prognosticators in history, had one of his favorite tools was speed resistance lines. So if I go from this closing all-time high in the S&P down to this subsequent closing low, it forms 2/3 and 1/3 speed resistance lines, okay? The way you do it is very simple. Take a vertical line from the low close up to the high close, just come across from there, and you
Mm-hmm.
break it into thirds.
Wow, interesting.
1/3, 2/3, 3/3.
Got it.
Draw lines through them. If you break through the 2/3 speed resistance line, you should get to the 1/3. Well, guess where we are now, folks, right here. Now, these are not like trend lines. A lot of times you'll get up to them, get a little bit above them, whatever, but you don't want to see them get too far above this line, because if you get above the 1/3 speed resistance line, convincingly, your next target is here, the all-time highs. And because I think these all-time highs were so important, and I'm going to discuss that at the June conference, I don't think we're going to get significantly above this 1/3 speed resistance line. And as you can see for the first time today, this little gray bar, I don't know if you can see it, is today's market action. I'm
Yep.
glad to see that we finally hit the line and we're a little bit above it. That's fine. And with that, I'll end my presentation.
So my takeaway, tell me if I've got this right, is we really shouldn't see, you don't expect to see the market much higher than where it is today.
Correct.
And you think that this rally has run its course.
Yeah, and if I mean,
But what
but
would
I'm
change your mind is seeing it above 5,700 in a sustained.
yes, I'm flexible enough to say, okay, if this thing gets up above 57, 57.50, I have to allow for the possibility we're going back to the old highs.
And you wouldn't still be in this business if you weren't flexible.
Thank you.
Wonderful. Thank you so much, Peter. Appreciate
My
it.
pleasure.
Yeah. Jake,
I'm here.
fantastic. Here and ready to go. Love it.
Very good.
Beautiful.
Thank you for having me. And ladies and gentlemen, please forgive the raspiness of the voice. It's not only a raspy voice, but it's allergy season here in Santa Cruz, California. I want to thank you all for giving me the opportunity to present, and of course, to the Foundation for their excellent work. So what I have for you today is very simple. I've got 4 pretty charts for you and 1 beautiful chart. And this is one of the pretty charts. This is my cycle, and let me stress, my work is very simple. I don't use a great big analyzer tool for software for finding cycles or anything like that. I find them visually and mathematically. The cycle we're looking at here is the long-term cycle in interest rate futures, particularly bonds. So as the cycle is moving down and prices are moving down, interest rates are moving up. As interest rate futures are moving up, prices are moving down. So we have a situation with a very beautiful cycle, certainly not perfect, but very beautiful, indicating what? Indicating that we should be in an uptrend, at least until mid-cycle, which would be the end of 2026, which means lower interest rates. Lower interest rates means higher futures. Higher futures means higher stock market. I have something else on the chart that's very important. At the bottom of the chart, we have small trader sentiment. In other words, when a small trader is very bullish, in this case 80% bulls or more, we tend to be near a top. When a small trader is very negative, 80% bears or more, we tend to be near a bottom. And as you can see, that works out very nicely. But we know that cycles are not perfect, so the next step is we need to use timing. So when we have a cyclical low approaching, we go to our timing indicators, which tell us whether to be long or short and when to execute a trade. Additionally, on this chart, we have commitment of traders, which is a very important piece of data. And this specific data says what are the positions of commercial traders, the biggest traders in the world. So when the indicator is green, it means commercials are buying. Let me give you a little example that is a little off the wall for you, but I'm going to do it anyway. I'm going to show you the next big bull market. Just one moment, let me get it. And yes, you are surrounded by old people. One moment, please. Here we go. So here's another chart. This is a chart of cotton, C-O-T-T-O-N, cotton. You might say, well, that's certainly not very exotic. We're interested in bonds. We're interested in copper. We're interested in gold. I want to show you a situation. That situation is right over here. We have a cyclical low that formed over here. It's not a perfect symmetrical cycle. And we have the strongest commercial buying activity in many years. This is a very significant combination in and of itself. What it means is that the end users, the producers, the folks that really need to use this product, cotton, are big buyers. They can buy on a scale down, they average their costs all the way down. And then eventually, as in this case, the big move begins. So they are in effect leading indicator. But adding to the equation, we have this, the small trader, the trader who most often loses money, which I know does not include anyone here today. The trader who often loses money is the most negative they've been since all the way back here, which preceded a similar combination, commercial buying activity, small trader negative, and the cycle moves higher. Very important situation. Notice again, the negative small trader right over here in front of one of the biggest rallies, if not the biggest rally in the history of cotton. So why cotton? Well, I'm not a weather expert. I'm not a cotton expert, but I did see something very interesting in the writings of Edward R. Dewey. If you go through Dewey's work, he stated that he had seen a relationship between the price of cotton and war, W-A-R. Well, certainly we can't deny the fact that around the world we've got war going on everywhere. Soldiers get killed, their uniforms need to be replaced. Maybe that's the fundamental behind it, but I don't know fundamentals. I do know this. I'm predicting for you a huge bull market coming in the price of cotton. There are many ways to participate, but remember, in my equation, setup, trigger, follow through. This is a setup. We need to wait for a trigger. The trigger would consist of what most people call timing, and timing is what we're looking at here. So we'll see what happens. I think we could easily lead to a situation like this. Let's see what happens. Let me show you another pretty picture. One moment, please. Here we go. With all due respect to Peter, I do not believe the stock market has topped out yet. In fact, I think we are nowhere near a top. In fact, we have much higher to go. But I want you to see what's happening here. This is quite dramatic. This is a chart of the Russell 2000. Not only are the cycles reasonably symmetrical, not perfect, but symmetrical and reasonably so, the cycle low is happening right now in the smaller stocks, in the lower tier of stocks. But I want you to look at this. We have got the largest accumulation of long positions by commercials in the history of the market. And you'll see what happened again. Commercials floated the boat with net long positions, and the Russell went much higher. You're now beginning another segment in terms of the cycle, and commercials have started buying again. So watch the Russell, because I think that's where the big move is going to be. And just out of curiosity, let me show you something. Here is the NASDAQ. Let me get the right chart. Just a moment, please. Remember, listen to the quality of the material, not the quality of the voice. Look what happened in the NASDAQ before this cycle right over here. Again, accumulation by professional commercial traders in anticipation of this big move. So commercial activity is a leading indicator. And also notice at the very bottom of the move, before the huge move up to the upside, we had the smallest small trader sentiment, the most bearish small trader sentiment in the history of this market. Again, lined up very closely with this bottom. So get ready for another move to the upside, but this time in the IWM where people least expected. Let's look at another one. One of the most perfect cycles ever. The Japanese yen. One moment, please. And here's the Japanese yen. Let's compress the chart a little bit. And here we are. A near perfect cycle in the Japanese yen per US dollar. And that's the Australian. Sorry about that. Let me get the yen. Here we go. Japanese yen, a beautiful cycle, not only beautiful in terms of cyclicality, but in terms of consistency as well. So what do we see now? We see massive commercial buying over here, consistent with the expected cyclical low. Again, cycles are not perfect. Small trader negative. And so this is a projection of Japanese yen. We've already seen some of that move start. So the forecast is real simple. Expect the Japanese yen to gain strongly on the US dollar. That should occur over the next several years. Let me show you one more. Pound sterling. One moment, please. And here's the British pound, which for many years has shown approximate 8.1-year cycle. We're a little bit late or early on the cycle, but again, we have all the indications that commercials and banks have started buying the British pound, the pound sterling against the US dollar. That's the situation there. So let me review a little bit and make this very easy for you, Richard, because I'm sure you'll have some questions for Peter and myself. Number one, I do not believe the stock market has peaked. I think we're going higher, but it won't necessarily be as strong in the S&P. I believe that tech stocks will go higher again as well, and we'll like to reach new all-time highs. But I think the real big move will be in the Russell 2000, where you have still very ground floor opportunity to take part in that market trend. So I'm effectively done. I realize I went through it quickly, but there's not much to say. I don't talk fundamentals. My indicators are very simple. I like to keep it that way because that's what made me the most amount of money. Richard, back to you.
Thank you very much, Jake. So this is, of course, you both know because you wrote wonderful testimonials. We republished Dewey's book from the early 1970s in the end of 2023. And this was a chart that we included there in the preface of the 41-month cycle in stock prices that Dewey had tracked. My apologies. This shows it back to 1954. Dewey had actually shown it back into the 1800s. And in particular, we'll zoom in on this, but we highlighted the current iteration of that 41-month cycle. And this was the chart that I made at the time in November of 23 to give to the publishers, and it showed the S&P 500 here with the 41-month type cycle right in the middle of these two lines, which puts us right at the end of 2024, beginning of 2025. Here is a closer view. This is the Foundation's cycle analyzer, which is based on the methodology developed by Dewey and the Foundation for the Study of Cycles for cycle detection. And it's been greatly enhanced particularly by Lars von Tienen, together with myself. And this is, let me just make this bigger here. Okay, so this is the full chart. And this was as of October 28th of 2024. This is the 184-week cycle, which is just a little over 41 months. And the cycle that we talked about in the book. And this is the out of sample, the light blue color here, okay, shows the 41-month cycle. You'd have to say absolutely nailing the top. And in particular, we got a supporting indicator here, another proprietary innovation from the Foundation and Lars von Tienen called the cyclic RSI, where we came up and touched the top of the blue band and then started moving our way down. So that was You can call it chaos or you can call it cycles. I prefer to call it cycles. And this cycle still projects, headwinds for the markets into 2026. And together with the concerns of eminent market analysts like Peter Eliades and others, Stan Harley, there is ongoing concern that this is a very significant top, or maybe we'll have some new highs and then a deeper correction, but we'll see. But still, for now, I just wanted to highlight how well the cycles did on this particular correction. Now here we're looking at the daily cycles. And again, okay, I'm just going to zoom in here. This was as of November 27th, 2024, and everything here is out of sample. So this is, we had the weekly cycles, and then we zoomed down into the daily cycles. And, yes, this rally got a little extended here, but between, this top here caught it very nicely. And again, this forecast was made back at the end of November 2024. So all of this is out of sample. So that's the history. Now let's look and see what the current cycles are saying, because this is dynamic cycle analysis. So here we are looking at the weekly cycle analysis on the cash S&P 500. So we've taken this back to roughly the bottom in 2009, coming out of the financial crisis. You can see the cycle isn't perfect. There have been some right extension, as we say, moving, tops a little later than the actual top in the cycle. But here we are today, and clearly we've gotten a significant bounce down near the bottom of the momentum indicator. But I don't see an all clear signal here yet. Like to see that come down below the bands. We'll see. But again, caution from the most important cycle in the stock market into the end of 2026. So I'd call this headwinds for sure. Meanwhile, we get to the daily cycles, and it's a totally different story, okay? This was the daily cycles out of sample back here. You can see even here that we have reached the bottom of those cycles, 182 and 180 days. And here we are today, the latest analysis. And we can still see, let's just go back to the 182 and the 180. They're now 178 and 78. We have a big buy trigger on from the momentum indicator down here, okay? And these daily cycles, it's about as big of a buy signal as you get from cycles into August. And if we go look at some of the other cycles selected by the AI, all of them are lining up for a significant rally into August with a significant buy signal from the cyclic RSI. I did cover earlier this week, there are some warnings from shorter term intraday cycles, but on the whole, this is pretty compelling buy signal from the daily cycles that could extend into the summer. That's what the cycles are showing. Doesn't mean it has to come true, but that's what the dynamic cycles, the methodology developed by the FSC, is showing for the S&P. So I want to connect this now with gold, because I'm going to get to a chart that really surprised me. So, of course, the media is full of talk right now about how gold is going to increasingly replace US Treasuries as a, neutral store of value, as opposed to US Treasuries, which are, um, partisan on behalf of the United States, and the United States is putting its global position and its friendships at risk at the moment. And so we see all over the media, gold's going to go up and stocks are going to go down. It's not what the cycles say. Gold on a weekly basis has a very clear cycle here. This 230, and this is the algorithm detecting the cycles. Okay. Yes, we are just right at the top of the cycle. Doesn't mean it's topping right now, although I kind of think it is. But we're closer to a top in gold than we are to a bottom, both in gold and in equities, right? So that's the weekly cycle. We look at the daily cycles in gold, also past the top now. Okay, got the 266 day and the 109 day are the top cycles here. Maybe a little more from the longer term cycle, but the shorter term cycle topping, that's the number one cycle, and a momentum sell signal here from gold. So contrary to equities, we actually have from the daily data a sell signal in gold. And finally, I wanted to bring your attention to this, which is the ratio of the S&P 500 to gold. Okay. So I've taken all of the cycles selected from the AI here, the number 1, 2, 3, 4, and 5 cycles. This suggests that the S&P 500 is going to do better than gold, okay, into 2026. And we can go back and look at that a little more closely. There's one cycle that still suggests some downside, gold gaining on the S&P a little bit. And I don't think it's out of the question that we could see another correction before a strong rally. I'm kind of leaning towards the long side myself in the short term right now. But when we put all these together, this is weekly data, okay, pretty compelling buy signal on the S&P gold ratio, okay? And then on the daily data, similarly, very compelling cycles. They have good definition in the spectrum here, good Bartels. And when you add them all together, they suggest the S&P gaining on gold significantly again through August. So I thought that was very interesting. It kind of went against the concerns that I have when I listen to the media and the things that get stirred up in me, right? That, boy, you got to get into gold now and you got to get out of stocks now. But the cycles are saying exactly the opposite. Last thing, and this I always compliment the McClellan, Sherman McClellan, and Tom McClellan, who will also be joining us at our Live in 25 conference. So excited about that. This is the 2-year Treasury yields here in green, and this is the Fed funds rate. And you can see that Treasuries typically lead the Fed funds, the 2-year Treasury rates, rising here, Fed funds rising into that. And there's plenty of room for the Fed to cut rates, which of course would be very likely be a boost for the markets. So that's what I'm seeing. Just to reiterate, we do have this weekly cycle, 41-month cycle, which is very important, dates back to the 1800s, giving a caution sign. But the daily cycles say, we've had a good correction and likely higher overall into the summer. Gold topping, including on the dailies, a little past the top, and the S&P 500 most likely to do better than gold from the weekly data and from the daily data, and the Fed likely to cut rates sometime in the next couple of months, maybe even next week.
If they don't get fired first.
If they don't get fired first. So we'll have a little roundtable discussion. Before we do, though, let me just give everybody one more invitation here. So Larry Williams, of course, will be joining us. I mentioned Tom and Sherman McClellan. We've got Peter Eliades, Elliot Prechter, son of Robert Prechter, and doing some very interesting work himself with Elliott Waves and technology, Akhil Patel. And of course, your FSC board members, including myself, Jake Bernstein, Lars von Tienen, Bill Cerubi, Andy Pancholi. So it's going to be an incredible gathering. And thank you to a special donor that we're actually able to offer 10 scholarships. So I know, this conference isn't free. Okay, I get it. We have to fund the conference and pay for the conference. We're not really taking sponsors for the conference. And we are a not-for-profit, but we are able through a generous donation to offer 10 scholarships with a $300 discount. So you can get a $300 discount off the entry price, and you can get that special offer through May 9th, the first 10 people to join by May 9th, cycles.org/live-NLI25-scholarship. So please take advantage of this and join us in New York. And thank you to our donors who have made these scholarships possible. We only have 10, and they're only available through May the 9th. And you get a $300 discount off the membership at LI25-scholarship, LI25-scholarship. All right. Gentlemen, thank you again. Appreciate it. And Peter, I'm curious if you have been swayed at all by the other presentations.
Take a guess on that one, Richard.
Well, I think it's very interesting too. And I wanted to kind of ask you both, with all your experience, there's this famous saying in the markets, bulls make money, bears make money, pigs get slaughtered. And maybe you could speak to that a little bit.
Yeah, well, that's absolutely true. And one of the things you should never do is be inflexible. We talked about flexibility earlier. So I need to see things in terms of an overall perspective, Richard. In fact, I want to show you all a chart now. If I share my screen again.
Great.
Have all of you seen this before?
This looks like Robert Prechter's
Absolutely. This is a
valuation terrifying chart.
remarkable chart. Now, don't get me wrong. If someone talks to you about valuation, say, no, you can't do it. The market's overvalued. Well, first of all, I don't care about valuations unless I see something extreme happening in the market. I would argue to you that now, regardless of what valuations may be subjectively, or even if you have an objective way to measure them, they aren't important to me at all until we get to a point where I see things like I talked about earlier with long, very long-term cycles, the longest ones that I have ever found, And when I see something like this, and by the way, I don't know if the most recent reading is even on here.
I know. I
Oh,
don't
there it
see.
is. There we
Oh,
go.
wow.
24. I mean, this is just remarkable. So what are we looking at here? Well, on the left is the S&P Industrials, the S&P 400
Hmm.
price to book value ratio. On the bottom, the horizontal scale is the annualized dividend yield. Now, I might add that Edson Gould, whom I mentioned before with the speed resistance lines, one of his favorite valuation indicators of all was what's the dividend yield? Because he said dividends don't yield, and that's what investors get to put in their pocket. So dividends are very important.
Mhm.
All the rest is promises. You can look at PE ratios and things like that, and they vary dramatically from year to year, even month to month. These things don't vary that obviously. So when you see a dividend yield under
It is.
1%,
Go
what?
back to the top there so we can see where 2024 was. There
Sure.
it is. Wow. And it's
When you
interesting there with 98, 99, and 2000 all being way over on the right too.
Yeah, I mean, just look at what's happening here, vertically and horizontally. Anything you see here is 1998, 99, and of course in 2000 we had a pretty big decline. Here's 2009 right here, the
Hmm.
major low in the market. And from that point on, and at this point, would you say that we're undervalued? No, 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 no. Undervaluation, at least historically, has to get down here somewhere. You
Hmm.
have to get to a dividend yield. It used to be that a dividend yield of 6%, which is right about here on the horizontal scale, 4, 5, 6, 7, 8. So 6% is right here. So if you get to a 6% dividend yield, then you're talking about a market that's undervalued. Well, how many times have we seen that? I mean, you don't see anything under 6%
Yeah.
in the last 30, 40 years. So this would argue that either you don't pay attention to this stuff anymore because it's completely insignificant. I don't believe that, and I don't think you should, or else the parameters are changing. But isn't it interesting that everything you see over to the right and vertically are the numbers that we've seen in the last few years? So someone needs to explain to me when they see where 2024 was and 25 isn't even on the chart. Of course, the all-time high, the all-time high in February of 25 should be on here, but I don't see it. But someone needs to explain to me how that can be very bullish when they see
Mhm.
where the valuations are. Again,
Wow.
I do not claim this is a timing tool. If you used it for timing, you'd be horrible at market timing. But when you fit it in with the other things that you look at and see where we are, there are two valuation metrics that I respect greatly. One of them is this chart that Bob put together. The other one is by John Hussman. I don't know if you folks have seen the
I'm
Hussman.
familiar with John. He does good
Well,
work.
his valuation is exactly where this is, off the charts.
Yeah.
In fact, we have now gone above the valuations of both 1929 and 2000 into
Yeah.
no man's land, someplace we'd never been before. Now you can rationalize and say, yeah, but this is, remember, AI, artificial intelligence, that's going to change the world. Well, I think they said the same thing back in the 1920s, late 20s, when they talked about the radio and all the new technology that was happening at that time. And in 2000, when they talked about, the tech uh, incredible madness that went on there. Well,
Yeah.
this beats it all valuation wise. We are at levels we have never seen before. Does that
Yeah.
mean that you can't go any higher? No, it never meant that. It just means that you should know where you are. Now, here's the last thing comment I'll make on this. When you're down on these levels, you don't look for anything big to the downside. Sure, you could have a bear market, 6 months, maybe a year or two, but you're not going to see anything dramatic to the downside. But the further to the right you go and the higher up you go means the more vulnerable you become. And when you get into areas like this, by the way, look where 87 was when they had the market crash. This is right over here.
Mhm.
So this was August. The high in 1987 occurred on August 25th. And this is where the valuation was at that time. And of course, in October, we had a 35 to 40% crash in the market. Just imagine what the potential to the downside is here. It doesn't argue you're going to crash. It just says that your vulnerability is great. And I'll leave it at that.
Thank you, Peter. Jake, what does it mean? What does bulls make money, bears make money, pigs get slaughtered mean to you?
Good question, Richard, and thank you for that, Peter. Great presentation. As an investor, I have one concern, that is managing risk. I always want to know if my risk is to be long or short. Where's the least amount of risk I can take? And in that process, I consider two very important variables. Number one, what are the professional traders doing? By which I mean the end users of those products, whether that product is money, corn, soybeans, gold, makes no difference. I want to know what they're doing. And that information is available to us every week in the Commitment of Traders report. The third variable, what's the small trader thinking and acting upon? Once I have those considerations all set, it makes no difference to me whether we're at all-time highs, all-time lows, bullish, bearish, irrelevant to me. 4 years ago, we predicted on the basis of cycles, small trader sentiment, and Commitment of Traders professional positions that gold would go to $3,600. We came shy of that target just in the last few days, and about a week ago recommended taking money off the table. All of that based on risk analysis and what the small trader is doing. So I have no fancy theories. I have no projections based on ratios. I have no projections based on fair value. I'm simply looking at the cycles, Commitment of Traders, and the small trader. And then I put timing on it, and that timing tells me what to do. So that's my only comment, except that some of the work that Peter showed is brilliant. It's a beautiful picture, but to me, it means nothing. It helps me do nothing aside from the indicators that I told you about. And that's what I have to say.
So I'll ask you both. Peter, what would make you change your mind?
Well, when you say change your mind, change my mind that we could go to new all-time highs.
Mm-hmm.
I mean, I'm flexible enough to know that that's obviously possible, but at that point, we'd be even more overvalued on that stupid chart I showed you. So,
Yeah.
are we in a whole new world here? That's the question you have to answer. If you think that artificial intelligence is going to completely change the world and that the valuations that have counted for the past century or more no longer count, that argument has been made at every major market top. It's the same argument you hear over and over again. So to change my mind about the short term and could we go back to the old highs and perhaps extend them even a little higher, I have to allow for that possibility. I think my cycle projections will let me know if that's about to happen. And they're not saying that right now.
Yeah.
Although I showed you an offset that if we get above, it's going to predict that we almost get back to the old highs.
That was
So,
5,800 on the S&P cash.
yeah, if you get above there, I think you're going to get what I call that was a 5 week offset. So it would be a nominal 10 week projection.
Yeah.
And that would call for us to go back either, I didn't look at the exact numbers, but either back to the highs or a little bit higher. I don't see anything dramatically higher, but I have to allow for that possibility. But based on the things that I saw happen Yeah, and you saw how strongly worded my updates were
And
as
how
the all
precise.
at the all-time highs. Um, you're going to have to really twist my arm really high and hard to
Yep.
have me think that the market has some great potential to the upside.
Yeah. So Jake, I know you have a setup trigger follow through process. So you showed in particular the Russell that you thought was going higher. We saw the setup. Have you seen the trigger?
We have not seen the trigger yet. Excuse me, we have not seen the trigger yet, but I wouldn't be surprised if it came in the next few months. You also want to look at the mid-decade pattern, years numbered 5. In years numbered 5, if you have 2 consecutive monthly closes above the January high in the Dow, you get a very bullish signal. And that's what I'm waiting for. So as a risk manager, it's all about timing for me. With all due respect to anyone else's theories, it makes no difference to me what valuation may be because it's all relative. And as far as AI changing the world is concerned, it's already happened.
It is happening, and let me ask you both this, what I see, there is something different today than there was 50 years ago, which is that our world has become so financialized, right? Um, and it seems to me like digitization and financialization kind of go hand in hand. And so, I think the financial sector is something like 30% of the economy now, and it just wasn't that way back when. And I think that I don't really know how sustainable that is. I personally have concerns about what I consider kind of the hyper financialization of our world. Um, I'd like to see a little more reality. But I do think that that is different than it was, 50 years ago. And you two have seen it, unfold in real time from your 50 years each in the markets. Any thoughts on that?
Yeah, I'm starting to feel pretty old.
I think Jake and I first met on the old Financial News Network. So
Right.
if you even remember that, you're old, all right?
I do.
So that was
I'm old enough. And I was in Los Angeles, so
yeah, I think what was that, 1970s? It had to be around the 70s. And by the way, if I can do a little bragging here, I will say that, and thanks to Cycles, in 1974, for several months on KWHY, which is the nation's first financial station, I had said beginning around the middle of the year after a long bear market, it was only from Jan 73 to December of 74 on the Dow, but on the overall market, it topped in December of 68. So that was a 6-year bear market
mm,
and down about 75, 80% in the overall stock market coming into 1974. And I said, because of a 212-week cycle, go back and look at your charts, that the stock market would see a very important bottom the week of December 9th to 13th of 1974. And exactly on December 9th, 1974, the stock market bottomed and the rest is history. Now, let me add one more thing. That December 9th date is going to be very important in the discussions that I have in June about how I pinpointed that February 19th as a potentially not only an important high, but perhaps a landmark high that could last for a generation or more. Now, if you think that sounds ridiculous, what a ridiculous thing, Eliades, a top lasting for a generation. I want you to, again, visualize the valuation chart that I showed you. And again, I never use that for timing, but you can use it for where you are in the overall picture. So from that 1974 low, when the whole world was bearish as hell and thinking we're going to hell in a handbasket, that where cycles pinpointed that low, a 212-week cycle on December 9th to 13th of 74, we've made the complete quarter century trip. I'm giving away my
Half
part of
century.
my thing now, but the quarter century from the 74 low to the 2000 high, another quarter century from the 2000 high to the 2025 February high. I'm not going to say anymore because I'll spoil my June presentation. But
All right.
these are long-term cycles I'm talking about, Richard.
Thank you, Peter. Jake, do you have anything special in store for us in June?
It's going to be a surprise indicator that I've been working on. And that's all I'm going to say.
Ooh, a new indicator from Jake.
Yes.
All right. Well, thank you both so much. Let me just put up one last time the special link that anybody watching today can take advantage of a $300 discount. Only 10 of these scholarships available and need to be secured by May 9th at the latest, but only 10 are available. Cycles.org/LI25-scholarship. It's going to be Peter and Jake. It's going to be Larry Williams, Sherman, Tom McClellan, Akil Patel, myself, Lars Von Tienen, Bill Cerubi, Andy Pancholi, and I don't know if everybody caught my interview over the weekend with Janne Miettinen, who harked back to the founding of the foundation back in the 30s with the Matamek conference. Really exciting stuff on biological cycles. So please do join us in June. It's going to be an incredible gathering. We've kept it small and intimate so we can really dive into cycles together. And it's not going to be live streamed. This is an in-person conference, so you're going to have to be there and you're going to want to be there. Well, thank you again, gentlemen. Really appreciate it. Appreciate your decades of service and your help to all of us over the years, and really looking forward to being together with you in person in June.
Thank you, Richard.
Thanks, Richard.
Likewise.
All right.
Sorry I didn't have much to say.
Thank you, Jake. Thank you, Peter. And thank you, everyone. We'll see you again soon.